we are in the second half of the year, and we've seen, supposed to be mixed color for the first half, but when you calculate, especially from the markets, we won some great strides. We made some great strides in the first half. We saw how the Nigerian stock market overtook South Korea when it comes to the returns on investment. Nigeria was the highest in dollar term globally, so that's worth celebrating. But what can we expect as the trend for the second half? We have joining us here in the studio investment research analyst from Afrinvest West Africa, Mr. Nathaniel Disu. Mr. Disu, good morning. So let me pry a bit. How much did you make in the first So we heard that the NGX gave about 64% returns on investment in the first half, in dollar terms for that matter, not even in naira terms. A good one, even though towards the end it didn't look that way, it didn't feel that way. Even up to now we're trying to understand. But what can we expect for this second half, and what are some of those drivers that you see?
Okay, thank you very much for asking. And one of the things, before we find out what to expect in the second half of the year, we should have an understanding of what happened in the first half of the year. And like you rightly said, I think about a few days ago, or I think last week, it was actually announced that Nigerian stock market was the best performing in terms of dollar terms, and that indicates the resilience of the Nigerian stock market despite the macroeconomic challenges. We still see that Nigerian stock market continues to perform, and one of the drivers so far has been stable macroeconomic dynamics. We see the exchange rate, which is the major factor in dollar terms. Naira has appreciated about 4.5% thereabouts in the first half of the year, and we also saw how resilient corporate earnings also played into the market. So those are the things that has driven the Nigerian stock market momentum. As a matter of fact, in Afrinvest projection for the entire 2026, we actually projected that the market would return about 14.5% in the whole of 2026, but just within the first half of the year, it has already outperformed that target, and we see that trend still going into the second half of the year, and it's a good thing for the market.
So the second half can be kind of dicey. In fact, some people say people have started shopping for Christmas, especially because we have politics. That's big headline and everything. Do we expect disruptions from those areas?
So we don't really expect much disruptions, and that's why in the second half of the year we actually did a scenario analysis on what to expect in the bull case scenario, in the bear case scenario, and in the base case scenario. But on the base case, we expect that the market should return about 62.5%.
As in, are you talking about for the whole year, for the second half?
For the whole year.
No, but we have already done 64%.
No, we've done about
in the first half.
In the first half, its market ended about 47%. So as of April, it was.
You're talking about the market movement.
Yes, so the market movement, but we don't really expect much of pre-election jitter that would really affect the market, because I think one of the reasons is that so far we've seen a bit of stable macroeconomic dynamics, and the three main forerunners for the election are still those that contested in the last year. So we are still kind of seeing the same trend happen, and there are a lot of positive drivers in the market in the second half of the year that should still suppress any pre-election.
But let's also not forget that one of the drivers, so that positive outcome in the first half, you have reforms like in the pensions, which drove that positive movement. We don't have that in the second half, except we want to replace that with the IPO. Dangote refinery.
So that's a big one, because if you look at the size, at the expected market capitalization size that will come in due to the Dangote refinery IPO, that's also one of the main drivers that is supporting this bullish momentum. And also the FTSE Russell index reclassification.
We're still waiting for that. We have S&P also.
Yes, although S&P own is for 2027, that is more like a watch list. And I think a few days ago it was also reported that a delegation from the NGX.
They've not told us what they discussed. They've not told us.
I think one of the things that we're seeing is that that the NGX and the SEC as a whole, they are ready to cooperate with international investors. So the T+1 classification isn't really a bad thing on its own.
Is there a possibility to go back to T+2?
I don't think we would go back. because if we should go back, it's giving a sense of uncertainty, uncertainty, and that's what the market doesn't want. The market doesn't want uncertainty. So the T+1 on its own is not a bad thing. So it's just about how can they parley and work with foreign investors to find a middle ground, and I think that's the reason why we saw that NGX delegation go over in London to meet and say, okay, how can we structure this to make things work? Because for the local side, on the domestic on the domestic front, T+1 is actually good for us because you make a transaction. Yes,
markets, developed markets are using T+1.
Yeah, so because at that side, for example, in the US, UK, they actually trade in dollars, so there's no need of any much conversion and everything. So I think that's the issue that needs to be flushed out. So when they can come to a consensus, I don't think there should be much.
So do you think we're overestimating the impact of the Dangote refinery? Because since all eyes are there, when the market was bleeding, a lot of people say, investors are taking out funds for the IPO, which is in September, and all of that. Are we overestimating or over-expecting the impact of the IPO? So
the Dangote refinery IPO, it's more like a double-edged sword, and that's one of the things that drove the bearish sentiment that we saw in June, because the IPO, the money that would come in for the IPO is not going to come out of thin air. So that's why we see a lot of big investors are doing what we call, let's say, sector rotation or funds rotation. So they rotate out of some major stock listings and to raise funds for the Dangote refinery IPO. So while that would come in, some stocks might actually suffer in the short term because people would want to reallocate funds to the IPO, and that's one of the things that drove the market bearish in June, especially when the private placement came around middle of June. We saw investors trying to get
taking out funds from
so
for that.
It's a two-edged sword.
So when the funds eventually come in, hopefully, can we expect a lot of change in the market? Especially since that some of them will be recycled funds.
Yes, so one of the things that we expect would happen for that Dangote refinery IPO is that while some would tend to reallocate funds from other, there are also some investors that will actually put in fresh funds, like even the retail investors. Everybody wants to get a piece of the pie, and if you look at the private equity valuation of Dangote refinery currently is about $40 to $50 billion. So by the time the IPO would come in, we will convert that to naira terms. By the time the IPO should actually get, it won't be like it would
market cap.
Yes, so the market cap, it would really be high. So that's one of the things that we expect to drive the positive sentiment in the market, and it also unlock fresh capital.
All right. Okay. We'll keep our eyes on that and other issues. Thank you so much, Mr. Nathaniel Disu, investment research analyst from Afinvest West Africa.
Thank you very much. Thank you.